We're joined by Adrian Miller. He's head of global markets and fixed income strategy at Miller Tabak Roberts Securities. Adrian, welcome back to In Business.
Thanks, Margaret.
What is the prime driver behind this optimism in Europe today?
It's probably the overhang of the upcoming three-year LTRO that the ECB announced at their December 8th meeting. The thought of this facility providing a lot of liquidity for banks, particularly the troubled banks who have a lot of debt maturing in 2012, has gone a long way to calming markets.
So this is the ECB, the European Central Bank, basically giving like unlimited amounts of access to cash, to credit, to try to unfreeze the markets in Europe. Is it going to be successful?
Yeah, it should be. There's no reason to think that a lot of the banks who have upwards of 500 to 600 billion euros of debt maturing in 2012, particularly, like I said, the troubled ones, not so much the core European banks, but the more susceptible ones at the periphery will have access to capital that wouldn't otherwise be available to them, or if it was available to them, would be available at much higher yields that would be deemed unsustainable by the market.
Well, would those loans, the availability of that, truly unlock what has been an increasingly tight credit condition there in Europe? Like, what's to say that the banks will necessarily take advantage of it and then allow for more lending to happen?
Well, there's two sides to that equation. I'm not necessarily think there's going to be a lot more lending, because don't forget, the banks still have to increase their Tier 1 capital, which the EBA has said is lacking to the tune of 115 billion. This particular facility, this three-year LTRO, will be used to satisfy the upcoming debt maturities that these banks face. Raising the capital is the other side of the equation, where banks have said they're going to sell assets and cut back on lending, which will kind of have an additional dampening effect with the European economy, especially in Eastern Europe, where they contribute 50% of the loans.
As we head into year close, markets are going to be closed for a few days as well. What is your prime concern as to what might happen in Europe by New Year?
We still have, this goes a long way to satisfying some of the fears, but we still have to get clarity on the December 9th agreement of the EU proposal, whether that be a definitive number on the IMF loans, whether it be 200 billion or 150 billion. We still need some clarity out of Greece as to the bond swap terms and so forth. That's still a big point of contention.
We've heard that could happen within the next week or so.
It could, but there's a big gap, or at least there was a big gap between what the Greek government wants to use as an NAV number on the new bonds coming in at 4.5% versus what the investors wanted, 8%.